Wall Street still doesn't believe that the inflation shock is real, and this could be the biggest problem markets are making right now, because while stocks are still near highs, the bond market, oil market, and inflation-sensitive assets are flashing warning signs. That's right, scary YouTube intro. This isn't just about a CPI print, this is about a chain reaction that's happening right now with oil that then goes into transport, into food businesses, costs, mortgages, rates, and eventually the consumer gets hit. And market valuations all go down. So what are we talking about here? And what are Wall Street really getting wrong? Well, right now, a lot of investors seem to believe that this inflation scare will fade, that it will go away. But as you can see by stocks holding up, that this could be the case. The S&P just closed around 6,600, even with oil elevated and all the geopolitical tensions we're seeing with Donald Trump. But this tells us that the market is still leaning towards a soft landing mindset. In other words, growth slows a little and inflation stays manageable, and the Fed eventually cuts rates. That's still the dominant comfort story, but how true is it? And the markets often stay comfortable right up until the point where the data essentially tells us that comfort is impossible. So what's the Fed actually saying? Well, let's look at what's changed. The first US services inflation just got a lot hotter. Reuters reported that the ISM non-factoring index slowed to 54 in March from 56.1. This is actually the first time that the ISM in services has declined. This matters because, well, this tells us that inflation is still sticky. It's much harder to crush those one-off goods inflation when you have rising tensions. Oil is also doing significant damage here, with WTI settling around $112 and, well, that expecting to rise given all what's going on with Iran. That's not cheap energy. That means that the cost of everyone's business suddenly got a load more expensive, and that kind of energy bleeds into transport, packaging, airline costs, and everything else. This combination matters because it's the most dangerous setup for financial markets that we've seen. Higher inflation is bad, and it's bad for rates, it's bad for businesses, and it's bad for growth. And when you get both of these together, valuations come under significant pressure from both sides. So here's why it matters, and here's what most people think. The fact of the matter is the markets are totally underestimating the risk here with oil and risk with Iran. Inflation stocks don't stay nearly as concentrated or contained as many people believe. That starts somewhere obvious like oil, and it continues with what's going on with the Iran war. In fact, the IMF right now are even telling us that prices are going to go up, shipping's going to get expensive, input costs go up, companies pay more costs to move goods, and businesses pass those costs on, you guessed it, to you. Consumers at the pump are going to feel it, businesses are going to feel it at the pump, and this is where central banks suddenly become uncomfortable because they have to make a decision. And we know that the Federal Reserve right now essentially are not going to cut rates. This means that prices are going to stay higher for longer and inflation is going to stay higher, with the latest CPI expectational read going to be at 3.3%. That's a 0% increase, the biggest we've seen now since 2022. The real problem here is if oil stays elevated, that's where you are going to feel it. That's where everyone's going to feel it because everyday costs are going to go up. But why is the stock market not pricing this in yet? Well, because if Wall Street fully believed that inflation shock was back, the markets would simply not be as calm. Actually, yields would start likely moving more aggressively higher, and we're seeing the opposite. And long duration of parts of this market would suddenly feel more vulnerable. This may be because investors think that oil will calm down quickly. Why? Because Trump is trying to strike a deal. There's no surprise that Trump is either delaying or escalating what's going on in Iran. He needs to kind of secure a deal because right now there's a risk of massive inflation, and it's related to the data that we're going to see over the course of this week. This is all bad news if you are in the Trump administration, but the more important bit here is why gold, silver, and bonds also seem to form a big part of it because, well, the fact here is that we're seeing gold edging slightly higher. We're also seeing the bond market react, and even silver is actually starting to make a move. Why? Well, silver's held up relatively more comfortable than we've seen with gold and oil, but these are all indicators of what the market's doing. It's stress in the market. Eventually, though, one side has to adjust, and this could be a collapse in the commodities market. The S&P 500 may suddenly start to downtrend, and, well, oil continues to go up. The most important bit here is what's going on with the IMF and Federal officials all citing the same risk, which we've talked about with oil. And this matters because mainstream macro threat means that everyday investors also start to panic. So what's the bottom line here, and what do we need to understand as investors? Wall Street still doesn't fully believe that the inflation shock is around the corner. Stocks are still acting relatively calm, and oil is high, but service inflation is heading up. Borrowing costs are rising, and major institutions are warning that the risk is bigger than many people believe. So it matters in the market because usually when people think something's going to go wrong, it normally does. And the next for the inflation data reads are going to be some of the most critical that we probably see in 2026, because if this shock proves sticky and today's pricing stay where they are, well, it's bad news for everybody. So let me know what you think of this in the comments down below. As always, stay plugged into the markets by subscribing to the channel. And until next time, thanks for watching. I'll see you soon. Bye-bye.